Hi friends, my name is Host Eric. I'm the host of Talking with Famous People. And this video is going to be about cryptocurrencies, wealth, economics, stuff like that in general. And I would say it's a video that every economist, everybody teaching economics, everybody who's curious about investment or how the economy works needs to watch. In this video, using 12 paddles like this one with things written on them, I will explain wealth and currencies, fiat currencies versus other kinds of currencies, precious metals, for example. And I will explain blockchains and cryptos to the extent that it needs to be understood. Which is to say, I'm not going to go into too much depth, but give the gist of what you need to understand why crypto is not some sort of thing that's going to go away or whatever. First, we need to note that wealth is beholdens, attained, and retained. When you do meaningful work for another person, then they are beholden to you in some fashion, and you've attained a way to say, you must now help me equivalently, and you retain that until that beholdens is met, okay? Wealth, therefore, occurs first in a metaphysical sense, in terms of people's obligations to each other, and only later is it turned into currency. Commodities are different than wealth, although your wealth may include commodities. Commodities are fungible resources, things like lumber, oil, iron, wheat. People invest in commodities under the idea that I'm going to buy oil now while it's at a low price, assuming the price will go up, and then sell it later. Currency, then, is wealth made fungible. And in places like the United States, where the fiat currency is the US dollar, the government needs to infuse the economy with as many new dollars as is equal to the amount of total new wealth generated by the useful work done by the people of the country every year, or else you'll have deflation. All currencies are fiat currencies, including gold as a standard. So when the US had the gold standard, they said, well, it's not a fiat currency because you can turn your dollars in and get gold in return for them. But gold is just as much a fiat currency as anything else. It's just that it's one about which we all agree that it has value because, as I will explain shortly, it well meets the needs of currency, which is currency must be divisible, it must be non-counterfeitable, and it must have scarcity. Precious metals, therefore, are natural currencies. They're rare, they're soft, so you can melt them and form them into different shapes easily enough. You can thereby divide them accordingly, and they're not counterfeitable because there's a limited amount of them and you have to mine to get more. Digital objects are different from physical objects, such as commodities. Digital objects are essentially recipes that browsers follow within a frame. So a browser will interpret some bit of code to render the JPEG in this particular box on the screen, and that digital object is essentially a set of ones and zeros that, with assorted interactions with machine code and computer, etc., gets rendered into an image. It disappears when you don't need it, and it reappears when you need it, and it doesn't seem to occupy any space in the physical world, although it does occupy a very small amount of space. So, a big problem for the internet, naturally, has always been securitization. How do you determine that somebody is who they say they are? And then, of course, we can also discuss now the topic of NFTs, which is to say, what about digital objects that aren't counterfeitable, that I can't take away? So if somebody renders a JPEG on a screen, I can save image to my computer. I have an exact copy of that image, and it's I could make it so that it's indistinguishable from the object that was originally there if I messed with the metadata and stuff. And in other words, digital objects are counterfeitable. What do we want to do? What can we do if we want a non-counterfeitable digital object? And that includes objects that link to your identity, potentially. So security has been done thus far on the internet, mostly through walled garden and through individual enforcement actions. So, for example, if you start putting up YouTube videos of other people's music, it will get taken down because you're in the walled garden of of YouTube and subject to their, and thus copyright is enforced there, and therefore you can't do copyright violations there because they do a good job of making walls in their garden. Decentralization is the blockchain alternative to a walled garden approach to securitization. How do you know that only the authentic party is accessing the data that they're allowed to access? You can attain that decentralized through blockchain versus having specific security walls up for certain kinds of things. So to transition from blockchain technology that establishes the non-counterfeitability of a digital object into an example, we can look at digital US dollars. There's a crypto coin called digital US dollars that is always equal to exactly $1. And if you invest in it, it gets a specific APR, 5 point something% interest on it. It's like a savings account, except it's digital US dollars. In real dollars, we have numbers on them. We have various other ways to make sure that each individual bill is distinct from each other individual bill. And we can see there's a counterfeit because if two bills have the same number on them, then one of them is counterfeit. Well, with digital US dollars, blockchain technology ensures that the digital US dollar you say you have is actually distinct from every other dollar, and that anybody who attempts to fake it and say, I have that dollar, will be rejected by the blockchain defenses, okay? So in that instance, you're talking about a crypto coin that's always worth exactly $1, right? It's never going to go up in value in terms against the dollar, but it will pay you an interest rate in US dollar, in digital US dollars. You can convert from digital US dollars to regular dollars at 1-to-1 at any time, always. And then that brings us to the topic of transparent versus dark chains. So some blockchains, their purpose and desire is to keep a transaction record for every event that occurs given a bit of some kind of crypto coin, whether it's exchanged for another kind of crypto for US dollars, whether it's used at a store to buy an object, whatever. It wants to keep a record of all that. Versus dark coins like Monero, which is used on the dark web to buy drugs, which keeps no record of transactions. Cash, it should be noted, does not keep a record of transaction. Physical cash. So crypto coins and tokens. Why are there multiple of them? Why should you purchase them or not? Or why do they have any value at all? How does that work? Well, it works like this. So I'll use a querying the blockchain example. Querying the blockchain for information, depending on the kind of blockchain it is easy enough to get information that validates the authenticity of something, but it can be difficult to compile information regarding the blockchain using parametric searches and stuff like that, such as show me all the examples of transactions that occurred between wallets that possessing less than for example. In that case, querying the blockchain can be very difficult and time consuming. So if you want to use it to validate, which it's supposed to be used for, then no problem. It's pretty quick. But if you want to use it to garner other kinds of information, it can be very cumbersome. So there's a crypto coin called Graph, a blockchain dev app called the Graph that's used to allow developers to better query the blockchain. Every use of this, of course, is going to cost a fraction of a cent. And if they are getting paid by the Graph to do anything, they'll be paid in the Graph's tokens, which is a crypto coin called whatever, Graph or something like that. Thing is, accordingly, since you can only do business within the Graph ecosystem in that coin, and that coin is always subject to market change in terms of its value therefore links directly and irrefutably to however many developers are using the Graph, and thereby spending money and getting paid in money in that crypto coin, which they then convert to their native currency, right? So in other words, whether or not a crypto coin or token is valuable is going to depend on how much the ecosystem in which that blockchain token has value is used by developers. In that regard, crypto is very much like the stock market. If a company is successful and then the stock price goes up. Well, if a developer environment or some sort of dev app like the graph is successful and people start using that ecosystem to generate a variety of applications for the blockchain, including information data gathering and compilation, etc., or using it for purposes like validating identities and stuff, whatever they're using it for, the more that those tools are used, the more that token in that environment produces and uses as a currency becomes valuable as a commodity or a security. Most of the crypto coins are best described as securities or digital commodities or something, except they're not securitized generally. But the contrast between crypto and the stock market is that crypto is much more like, in terms of the mechanics and dynamics of it, it splits the difference between trading in currencies. In other words, buying like US dollars and then selling them, buying like pound sterling, waiting for the price against dollars to improve from your perspective, and then selling it and getting more dollars than you originally had with just exchanging currencies, right? It's more like that in its mechanics than it is like the stock market, which follows, say, things like quarterly earnings. Then, of course, the last factor that is important in noting the distinction between, say, stocks and cryptocurrencies is that even though it's been around for 14 years, crypto is still fundamentally in its infancy compared to corporate business stuff, right? So you can foresee in crypto something equivalent to a dot-com boom, in that, yes, this technology will ultimately blockchain technology will ultimately be used in lots of digital environments for lots of different purposes, and will become very normalized as a means of doing business, because what blockchains allow companies to do is to buy and pay in their own token for services and stuff, whatever, provided, and then rely on the value of that token to rise as their developing environment becomes more well utilized, and their token becomes more well utilized, get more people paying them in that token. So if you want to utilize this service, you've got to buy that token and then pay them in it, right? So as this becomes more normalized in terms of software development and stuff, and as more developers begin utilizing blockchains for more purposes, then there'll be a separation at some point of those developing environments, dev apps, and level 2 blockchain stuff that really is effective and meaningful and takes hold as a dominant way to go, and those that don't. You've got your meme coins like Shiba and Dogecoin, and they try to attain value in ways other than utility of the kind that I described, right? And that would be a subject for another video. But this one hopefully introduces you to the concepts of crypto and stuff in a way that is more meaningfully explanatory than you've encountered before. Thanks for watching.